Infinite banking should never be used with an IUL. What is an IUL? It's an indexed universal life insurance policy. There are so many agents out there telling you to do an IUL, use this for infinite banking. Those people do not understand what infinite banking is. They're simply pushing a product that pays a lot of commission. An IUL year one pays up to like 120% commission. So if you put in 10 grand, the agent just made $12,000 the first year. It is not good for infinite banking. In this video today, I'm going to tell you and show you exactly why. My name is Devin Burr. I have been practicing infinite banking now for 5 years. I've helped thousands of people around the country do the concept at a high level. So I am an expert at this concept. This is not something that I just learned. I do it in my own life. I have 15 policies that I use for infinite banking, and I use it for everything. All my investments, all my purchases, I am the bank on. Here's the thing. People are going to tell you an IUL is the best thing to do because it'll give you a bigger rate of return. But if you dig a little deeper and see what an IUL actually is, you'll run the other way. This video is to give you that insight of what I've learned over the last 5 years. Let's jump into why an IUL should never be used. So real quick, for those of you that have not seen any of my videos and know what infinite banking is, very simple. It is just mimicking what banks do with money. And that way you get the benefits instead of the bank getting the benefits. Here's what banks do. Very, very simple concept. They get deposits, and those deposits in the bank are a liability because they have to pay you interest. It's their cost to control your money. So let's say when you deposit your money in the bank, let's say they have to pay you 1%, just making math easy. They pay you 1% to control your money, and since they control it, they can now take it and turn those deposits that are a liability into an asset by loaning the money out. So very simple. Liabilities take money out of your pocket, assets put money in your pocket. So since you're depositing your money and they have to pay you to do it, it's a liability. It's taking money out of their pocket. So all they do is they take it, they lend the money out, they turn it into loans, and those people that get those loans have to pay the money back with interest. So let's say they lend your money at 6% interest. So if it costs them 1 and they make 6, they're using your money to make a 5% return. But that's not the actual whole story. 1% is their control cost. That's the only money they're actually using of theirs. The rest of it that they're loaning out is yours. So they're turning 1% into 6%. That's a 5% net return from 1%. That's a 500% cash on cash return using your money. So infinite banking is simply doing that, but with a properly structured whole life insurance policy, not an IUL. And I'll get into exactly why that is. But it's the same thing. So you take your money, instead of depositing it into their bank, you create your own banking system. You deposit it into a properly structured whole life insurance policy, and then that money gets cash value, the cash value to mimic the bank. So when you use that cash value, you have to pay a control cost to the insurance company because you're not using your money. You're borrowing theirs. Your money is just held as collateral. So you're borrowing the insurance company's money at a cost, just like the banks use our money at a cost. So you're getting a loan from the insurance company. You're simply taking it and putting it to work to make a bigger percentage than what it costs you. The exact same thing that banks do. That's infinite banking. As long as you take what you're making from the policy, from these policy loans, and you feed it back to the policy, you're doing exactly what the bank does with money. You're mimicking banks. You're becoming your own bank. Let's get into, though, exactly why an IUL should not be used for this concept. All right, so before we get into exactly why an IUL should not be used, I want you guys to know this comes from a place where when I first learned about insurance, I got duped into two IULs. I got one on my wife and one on me. Altogether, it was $18,000 a month, or I'm sorry, $18,000 a year that I was putting into these policies. 3 years went by. I put $18,000 in every year for 3 years. Guess how much cash value I had inside that policy? $4,000. That's all I could use from my IUL to practice infinite banking after 3 years. Guys, that's not good. Remember, we're mimicking what banks do. Banks get deposits, they can immediately use that money to go lend it out. I was putting money into an IUL or two IULs for 3 years, and I only had $4,000 that I could use to mimic the bank. That is not good. What I did is I took those policies and I did what's called a 1035 exchange. I exchanged the little cash value I had into a policy built for infinite banking, a whole life insurance policy, one that gave me immediate cash value in the first 30 days. Not something I had to keep putting money into for several years. So guys, I come from a place where I might be in your shoes. You might be having an agent that's telling you an IUL, it's got the upside with no downside risk because of the market. All the things that they tell you, they're chasing commissions. And guys, this video is going to show you again exactly why an IUL should not be used for the infinite banking concept. So hopefully you don't get duped into one like I did. All right, so real quick, let's talk about what an IUL is. It is an indexed universal life insurance policy. It is pairing an index investment with insurance. And on the surface, you'd think that was great, right? An index can go up way more than whole life can. Whole life, you're going to get around 5 to 6% growth with your dividends annually. But an IUL might have a cap where you can get 12%, 11, 15, whatever it may be. It seems sexy when you look at it on paper, but here's the problem, is that the insurance portion of that contract is on a 1-year renewable term insurance. That means that every single year, the insurance portion, the cost, has to go up because every year you get older, you're more likely to die. So the older you get, the cost of insurance exponentially goes up. And the problem with these policies is there's a 0% floor. So they're saying if the index doesn't earn anything, if the index loses money, you can't lose cash value. And I guess that's true, but here's the thing. If there's a 0% floor, if there's no growth inside of your policy for that year, and your costs are through the roof, how do those costs get paid for? They don't get paid from your growth. There's no way that can happen. There's no growth. So you have to inject more money into your policy to cover costs, to cover fees, just to keep it from lapsing. And that risk exponentially goes up the older that you get, because again, you're just more expensive to insure. When you're old, you don't want risk, you want less risk. An IUL has more risk the longer you have it. Another reason why it should never be used is if you look at an illustration looks sexy with an IUL because they're assuming every single year that you're getting 8, 9, 10% growth. They're assuming that's going to happen every year. Anyone who knows anything about the market knows it does not go up every single year. There's down years. There's years where it might only go up 1%, 2%. There's years where it goes down 20%. But assuming every single year it goes up by 8, 9, 10%, of course it's going to look great on paper, but it's not accounting for those down years. Now, another reason, if you look at them, the guaranteed side goes to zero. So the only thing they can guarantee inside of an IUL is that it will go to zero. Your cash value will go to zero. That's crazy. That's the only guarantee. In a whole life, it's guaranteed to just go up. And that's what you want with banking. See, banking is a concept. It's the way money flows. It's the way money moves. It's not an investment. It's simply a concept of how to flow money. Infinite banking is just a concept of how to mimic how banks flow money, how banks use capital. If you can do that and be profitable with what you move the capital into, you can be extremely profitable with banking. Banking is the most profitable business in the world. So with that, you don't want risk. Banking should have no risk. It's just how money flows. And that's why whole life is the only product that should be used for infinite banking, because there is no risk. It is guaranteed to go up every single year without fail. It's guaranteed to have level cost. The cost will never go up. It stays exactly the same, contractually guaranteed. Fees, everything, they are contractually guaranteed to stay exactly the same. And then you're contractually guaranteed to always earn a certain amount plus dividends. So the longer you have a policy, the better it gets. With an IUL, that is not the case. And think about this. Whole life has been around for hundreds of years. IULs have only been around for, I think the first ones were in the 90s. So let's call it 30 years, maybe the late 90s. So they haven't stood the test of time. People that got them when they were real early in their infancy are just now seeing how destructive they can be with the cost of insurance rising. So guys, this comes from a place, again, where I was duped into getting IUL policies for infinite banking, and they were anything but that. They padded the insurance agents' pockets. And guys, full disclosure, I'm an agent. I write whole life insurance policies for clients because I used the concept. It made everything in my life better with money. So I figured, let me tell people, let me teach people. And as I started teaching people, everyone wanted to do it. So many people would ask me, hey, can you help me set up a policy? So in my mind, I'm like, if all these people are wanting to do a policy, how about I just set it up for them so it's set up correctly? This is set up by my team only to do infinite banking, which means low death benefit, low commissions, high cash value. That means that us as agents are making very little commission so that you can get a bunch of cash value to use to practice the concept. We're giving up our commission so you can have cash value to do the concept of infinite banking. Now, we do a lot of policies, so we make a lot of commission, but it's not because we charge a lot. We set the policies up so that you get the benefit, not so that we get the benefit. We just have to do a lot of policies and we do all right. So if you want my help and my team's help on doing infinite banking, so not only setting up the policies, we'll do that. We'll help you set it up, make sure it's not taxable, make sure it's structured correctly for your goals, your wants, and your needs, but then we'll help you use it. That's the secret sauce. If you have a policy, it's basically the best foundational asset you can have. But if you don't know how to use it, it's really a glorified savings account. So using the concept, using the policy is what me and my team specialize in. So go ahead and check out the link in the description of this video. Watch my free training video. There's no cost to that video. Just please watch that so you can get the basics of how to use the concept. And then you can schedule a call at the end with me and my team. So I look forward to helping you. If you liked this video, smash the like button, please. It helps the algorithm. We need more people to understand the risk of these IULs. There's so many agents pushing these and they're gonna blow up in clients' faces. So please share this video, like it, and if you liked this video, you're gonna love that one. Check that one out next. Until next time, I love all you guys. Peace.